Hey, how you doing? This is Adam Post, publisher of more than 1,000 comic books and marketing expert covering Disney. The Disney hostile takeover is going nuclear. Let's get into the story. Before we do, please be sure you are subscribed to the channel. Click the bell for notifications. Give me a thumbs up. I really appreciate you guys. Word just came out today from hostile takeover master Nelson Peltz that he is nominating himself and another person for the Disney board of directors. The big news here is that Nelson wants to put himself on the board. Self-made billionaire, guy who has done hostile takeover types of things like this before, as well as former chief financial officer for Disney, Jay Rasulo, on the board of directors. Jay Rasulo, who was with the company until 2015, does not agree with the direction that Disney has been going in. Of course, like many people, Rasulo was passed over and basically taken advantage of by Disney, not treated fairly by Disney. And as a result, he's more than happy to join with Nelson Peltz, get on the board of Disney, and try to push it back into going in the right direction. You'll also remember Ike Perlmutter, former CEO of Marvel, who actually brought Marvel to Disney, is also unsatisfied with the direction that Bob Iger and the board of directors have been taking the company. Ike Perlmutter's attitude is, hey, look, the stock is down more than 50% since 2021. You've cost him over $1 billion. So Ike Perlmutter wants to take his net worth in Disney and make it as valuable as possible, get the company managed properly so he can donate it to his cancer center to help cancer research and cancer care. That's Ike Perlmutter's agenda. He's an old man. He's not going to live forever. He doesn't want the money for himself. He wants it as part of his legacy. We'll cover this article from Variety. In Disney board fight, Nelson Peltz will nominate himself and ex-Disney CFO Jay Rasulo as director candidates. But we'll also cover the actual press release from Trian Partners, that's Nelson Peltz's company, making the announcement and all of their accusations against Disney and why it's important for Nelson Peltz and Jay Rasulo to get on the board of directors. Now, this guy, Jay Rasulo, was never mentioned before. And if you're not familiar with it, let's go over what a chief financial officer actually does at a company. The chief financial officer holds the top financial position in an organization. They are responsible for tracking cash flow and financial planning and analyze the company's financial strengths and weaknesses and proposing strategic directions. It's that strategic direction that matters the most for Disney. What is Disney planning to do with its future? Here's the full release from Trian Partners. Trian nominates 2 candidates to the Walt Disney Company board, believes the Disney board's lack of focus, alignment, and accountability has resulted in chronic underperformance at one of the world's most iconic companies. Trian Fund Management, which beneficially owns $3 billion of common stock in Disney, today submitted a notice of its intention to nominate 2 independent director candidates for election to the Disney Board of Directors at the company's 2024 annual meeting of shareholders. Disney is one of the most iconic companies in the world with unrivaled scale, unparalleled customer loyalty, irreplaceable intellectual property, and an enviable commercial flywheel. However, Disney has woefully underperformed its peers and its potential. It's great to see them mention the commercial flywheel. This is something that Peltz brought up the first time he was trying to get onto Disney's board of directors. The flywheel is like when they create content and a movie is so good that people want to buy the merchandise, that people want to go and see the character in the theme parks. That gives a Disney property the long-standing value that Snow White does, that the Lion King does, that the Marvel characters do, that all the Star Wars characters had. If you're not excited to buy Star Wars bed sheets, if you don't want to buy Marvel toys, then Disney is mismanaging the property. This flywheel is going to come up again and again because it's the flywheel that generates interest day after day, month after month, year after year, and decade after decade. Earnings per share in the most recent fiscal year were lower than the earnings per share generated by Disney a decade ago, and were over 50% lower than peak earnings per share, despite over $100 billion of capital invested. Margins in both Disney's direct-to-consumer business and its consolidated media operations significantly lag peers despite Disney having scale and superior intellectual property. The scale is just the fact that Disney is just huge. It is a huge business. It has a tremendous market share in film. It's got operations everywhere. It's involved vertically in multiple businesses and multiple distribution channels. Disney, aside from having direct-to-consumer businesses like Hulu and Disney Plus, even has its own cable type of business, a virtual cable company through Hulu Live. It has ABC, the network. It has multiple cable channels. All of that additional distribution should be giving Disney an opportunity to have very high profit margins because they can distribute their content in so many places. For shareholders, this subpar performance has destroyed value. Disney stock has underperformed the stocks of Disney's self-selected proxy peers and the broader market over every relevant period during the last decade and during the tenure of each non-management director. Furthermore, it has underperformed since Bob Iger was first appointed CEO in 2005, a period during which he has served as CEO or executive chairman, directing the company's creative endeavors in this role for all but 11 months. Disney shareholders were once over $200 billion wealthier than they are today. Unfortunately, the board and the CEO appear to have no conviction that things will get better. The non-management directors collectively own less than $15 million worth of Disney stock, and Mr. Iger has sold the vast majority of his ownership stake, built up primarily through share-based compensation, more than $1 billion of Disney stock, leaving shareholders alone to face the daunting reality of a complex turnaround in a rapidly evolving industry. The entertainment industry has its own problems. Disney and its other peer companies are having problems dealing with moving to direct-to-consumer, dealing with not having as much of an opportunity to do business in movie theaters, not having licensing opportunities like they used to have. A lot of that Disney brought on themselves. At the same time, Netflix has changed the industry a lot. That's why I'll say it's not just about diversity, equity, and inclusion and the woke agenda. Those are problems, but those aren't the only actual problems with the industry and the business. If you took all of that away, they would still have other problems, but at least they'd be focusing on what they should be focusing on, solving the secular issues, the industry changes, not trying to push a ridiculous agenda in the middle of all of their content. And this is a very significant issue that Nelson Peltz brings up, saying, hey, none of your board members actually own a lot of the stock. You're not focused on what's happening with the stock. You're focusing on what's good for yourselves. Bring on a couple of board members who actually have a significant investment in Disney stock so that you're doing things that seem to benefit the stock. Peltz goes on to say, that turnaround does not appear to be materializing. Since Mr. Iger's first earnings call after returning as CEO, tens of billions of shareholder value have been lost. Consensus earnings per share estimates for fiscal years 2024 and 2025 have fallen meaningfully, even as the company claims to be cutting billions of costs. And studio content continues to disappoint consumers, slowing the speed of the flywheel and threatening future earnings growth. Great to see that word flywheel again. It's supposed to be that Disney's brands drive their theme parks, drive their direct-to-consumer, drive their cable channels, because they own Star Wars, they own Marvel, they own Mickey Mouse, they own all of the Disney brands. They have so much that they control and that they own. Why aren't people excited about their brands anymore? That is not a secular change. That is a change on Disney's really sick focus on what they call decentering whiteness. And that's not just Disney, but it's something Disney is focused on doing. They want to change the culture and change all of their brands to match this new culture. It's not working for their business, and it's not working for that flywheel. It doesn't make you want to go out and buy sheets based on their new characters in the movie Wish. No one cares about those characters. More generally, Disney appears no closer to adequately addressing the compensation misalignment governance, and succession issues that have plagued the company for decades. The root cause of Disney's underperformance, in our view, is a board that is too closely connected to a long-tenured CEO and too disconnected from shareholders' interests. The board, we believe, lacks objectivity as well as focus, alignment, and accountability. Although the recent appointment of 2 new directors to the Disney board is a step towards greater board objectivity and a belated acknowledgement by company of the need for change, this reactive board self-refreshment on the eve of a proxy contest is insufficient, in our opinion, both because the new directors were chosen without shareholder input and because they seemingly do not own meaningful amounts of stock. And I will also say, I have never seen anything like this, with a company going through so many ridiculous hoops to try to avoid having an experienced person like Nelson Peltz join their company on their board. It's not something that's normally done. Disney even hired a new chief financial officer who has experience in fighting Nelson Peltz. He's from Pepsi, but he has no entertainment experience. He does have experience fighting with Nelson Peltz. Disney does that. They also named these 2 new board members because of Nelson Peltz's arguments about not updating the board. They added these 2 guys from Morgan Stanley and also a former CEO of Sky. And it's fine that they add these additional people. But in addition to this, they also instituted a new dividend. That was something else Nelson Peltz was asking for. They also agreed to lay off like 7,000 people. That's something else that Nelson Peltz was asking for. But what's ridiculous is just bring him on the board already. What is the big problem with Nelson Peltz? Nelson Peltz has experience with gigantic multi-billion-dollar companies, and he's been acknowledged as very effective on helping those companies increase their stock value. Here's from his Wikipedia. Under awards and recognition, Peltz was said by the National Association of Corporate Directors in 2010, 2011, and 2012 to be among the most influential people in global corporate governance. So what's wrong with this guy? Disney has no legitimate explanation. And back to the release from Nelson Peltz. Quote, as Disney's largest active shareholder, we can no longer sit idly by as the incumbent directors and their hand-picked replacements stand in the way of necessary change, and peers and competitors continue to outperform, said Nelson Peltz. In our view, Disney's board has failed to fulfill its essential responsibilities, overseeing the development of an effective strategy, planning for orderly succession, aligning executive pay with performance, and ensuring accountability for operational execution. Shareholder-led board refreshment with focused and aligned directors who are accountable to the owners of the company is long overdue. Trian's director candidates are dedicated, experienced, and positioned to help address the company's considerable governance, strategic, financial, and operational challenges. Trian's director candidates are Nelson Peltz. Nelson is Trian's chief executive officer and a founding partner, and has served as a director on more than a dozen public company boards, including at world-class companies with best-in-class brands such as Procter & Gamble, Unilever, H.J. Heinz, Mondelez, which makes Oreos, and Ingersoll Rand. Mr. Peltz's experience is unparalleled among public company directors, as is his track record for prompting bold action to drive operational turnarounds, transformations, effective leadership succession processes, and value creation across numerous industries. In addition to Peltz, he's brought back Disney CFO James Rasulo as a potential director. Jay spent 3 decades at Disney and served as Senior Executive Vice President and Chief Financial Officer of the company from 2010 to 2015. During his tenure as CFO, the company delivered compound annual returns for shareholders of approximately 27% and compounded earnings per share at a rate of approximately 20%, paid a consistent and generous dividend, and Disney's share price appreciated over 250%. Before being appointed CFO, Jay was chairman of Walt Disney's Parks and Resorts Worldwide from 2005 to 2009 and was president of Walt Disney Parks and Resorts from 2002 to 2005, delivering compounded high single-digit revenue and segment operating income growth annually. Bob Iger called Jay a vital contributor to Disney's success with strategic acumen and savvy insight. This compounded annual return of 27% and earnings growth of 20% annually, plus a gigantic dividend annually, a payout to shareholders, and a share price increase of 250% is very substantial. Disney was a smaller company back then, and it's easier to have an increase in share price when you have a smaller business to manage, especially if you don't have the same kind of gigantic industry changes like Disney's been going through. But at the same time, to have this guy on the board of directors makes a tremendous amount of sense. Quote, to resolve the malaise and crisis of confidence among Disney shareholders, the board needs fresh perspectives from truly independent directors selected by the shareholders themselves, Mr. Peltz added. Jay and I have the strategic, operating, financial, and governance expertise to help Disney and are committed to working with the other members of the board and management team to address the fundamental issues underlying the company's continued poor performance. There is much that can be done to revive Disney and restore the confidence of Disney shareholders, and Trian looks forward to discussing these opportunities with our fellow shareholders over the coming months. The other members of the board of directors do not want to be talking to Nelson Peltz or this former CFO because they know they're just letting Bob Iger do whatever he wants and signing off on it. There is no legitimate excuse for the mess that Disney has found itself in with its brands. The one thing that actually doesn't cost a lot of money, has nothing to do with industry changes, is just having brands that consumers love. Disney has always gotten that right. There's no excuse for not getting that right, except the whole silly concept of diversity, equity, and inclusion and decentering whiteness. None of that makes any legitimate sense and should never have been a focus of their brands. Quote, the Disney I know and love has lost its way, said Jay Rasulo, former CFO. As independent voices in the boardroom, Nelson and I are confident that the combination of my decades of experience at Disney, Nelson's significant boardroom skills, and history of driving positive strategic change, and our combined consumer brands experience and financial acumen will be additive to the Disney board. With a shareholder mandate, Nelson and I look forward to helping the board and management reorient the company towards delighting its consumers again and driving significant value for its owners. Trian expects that the 2024 annual meeting will take place in the spring of 2024. Shareholders do not need to take any action because there's no voting going on just yet for Nelson Peltz and Jay Rasulo to join the board. And here's what Nelson Peltz's Trian Fund Management is all about. This is what their business actually is. Founded in 2005, Trian Fund Management is a multi-billion-dollar investment management firm. Trian is a highly engaged share owner that combines concentrated public equity ownership with operational expertise, leveraging the 40 years plus of operating experience of our founding partners, Nelson Peltz and Peter May, and Peter May has been with Nelson Peltz for decades. He's also a great exec. Trian seeks to invest in high quality but undervalued and underperforming public companies and to work collaboratively with management teams and boards to help companies execute operational and strategic initiatives designed to drive long-term sustainable earnings growth for the benefit of all stakeholders. This is a major escalation of the Nelson Peltz versus Bob Iger fight. The hostile takeover is going forward. It's not concluded yet. Shareholders will have to vote to decide whether or not they want Nelson Peltz and Jay Rasulo to join the board of directors. Shareholders might say no, but this is kind of a big deal. This is not what seemed like Nelson Peltz originally had planned. He pulled this guy, Jay Rasulo, out of nowhere. Except for today, we had not heard anything about Jay Rasulo rejoining Disney, this time on the board of directors. He was at the company for 30 years in multiple roles at the company, all the way up to being chief financial officer. He knows where all the bodies are buried. He knows how Disney should be operating. He's openly said now he agrees with Nelson Peltz and Ike Perlmutter that something is deeply wrong at Disney. This is going to be a really interesting fight, and it's just heating up now. Let me know what you think of all this in the comments below. Always love to see your ideas. Please be sure you are subscribed to the channel. Click the bell for notifications. Give me a thumbs up, and I'll see you again soon with another video. And if I don't see you, I will miss you.